Welcome to Mourant Consulting's June 2024 training in respect of the AML, CFT and CPF regime and the AML-SP regime roles and responsibilities in Jersey. Our session comes in two parts, and first we are going to cover AML, CFT and CPF training specifically tailored for boards or those charged with governance. The global context for AML, CFT and CPF will be covered in this particular section. In the middle of the map here, you will see the FATF. And the FATF is the Financial Action Task Force, which is a global body that sets the standards with the agreement of virtually every country in the world that all countries will comply with in respect of anti-money laundering, countering the financing of terrorism and countering proliferation financing. In Europe, most importantly, a FATF-style regional body called Moneyval is coordinated by the Council of Europe, and you can see, for example, the Eurasian Group and the CFATF covering the Caribbean amongst the 8 FATF-style regional bodies. While we're looking at the global context, it's worth highlighting that the big countries in the world, by virtue of their economies, are all FATF members. And you can see a significant part of Western Europe, Australia and New Zealand, China, India, Brazil, and of course the United States of America, Canada and Mexico, all being members of the FATF. You will also note that Russia, shaded in a sort of pinky colour here on the slide, is temporarily suspended from its FATF membership, and that relates to ongoing conflict in the Ukraine. Then locally we have Moneyval sitting beneath the Council of Europe as our FATF-style regional body. The red circle around Jersey just to highlight that we are a member alongside Guernsey, Gibraltar, the Isle of Man, and you'll note that the main body of Moneyval members are in Eastern Europe, including Poland, Ukraine and several other countries. I won't read them all out now. That sets the scene for how Moneyval assess Jersey on an ongoing basis. It's also worth noting that technically Jersey is not a full member. It shares its membership with Guernsey and the Isle of Man. The reason that's important is because we don't have quite the same voice that a fully fledged member country would. We have to share it. Now, as mentioned, the FATF, through its work internationally, make sure that countries around the world all adhere to AML, CFT and CPF standards. And they have two lists, the first of which is a blacklist, colloquially referred to. In actual fact, it's the list of high-risk jurisdictions subject to a call for action. This is dated February 2024. The countries currently subject to a call for action are Iran, Myanmar and the Democratic People's Republic of Korea, or North Korea. What this means is that these countries do not engage in the FATF process at all. They have such significant deficiencies in their AML, CFT and CPF frameworks that globally nobody wants to do business with them. Now, there are complexities in that, but for our purposes today, it's very important to remember that any engagement with a blacklisted country presents extraordinarily high risk and is often outside of a business's capability to do business. The second list that the FATF maintain with the support of the FATF-style regional bodies is the grey list. And again, that's a colloquialism. What it actually is the jurisdictions under increased monitoring, again dated February 2024. Now, the jurisdictions under increased monitoring, you can see the list here, currently 22 countries around the world, are those countries which have been assessed by the FATF, but it has been determined that their AML, CFT and CPF frameworks are not either technically compliant, as in they don't have the right laws in place, or they are not effective, as in the supervisors that supervise financial services businesses or the police forces and the prosecuting authorities that need to take people to task for money laundering offences are not doing their job as effectively as is the international standard. The FATF set the technical standards through a document called the FATF Recommendations and their effectiveness standards through a document called the FATF Methodology. Now, within the methodology, the immediate outcome that measures the effectiveness of industry is immediate outcome 4. And it states that financial institutions, designated non-financial businesses and professions, and virtual asset service providers adequately apply AML/CFT preventive measures commensurate with their risks and report suspicious transactions. That fundamentally means that industry need to make sure that they know their customer, that they monitor customer relationships, and they report suspicion. We'll cover this in more detail later. Just to ground the FATF standards into Jersey's public policy context, it's important to remember that Jersey wants to maintain its place as a leading international finance centre, and a key pillar in that approach is by maintaining compliance with the FATF recommendations and methodology. Last year, in October, September time, we were assessed by Moneyval, and we will find out on the 24th of July 2024 how well Jersey has done. All signs point towards a strong outcome from that assessment, just like our previous one in 2016. But part of Jersey's approach is continually evolving its AML, CFT, CPF regime such that we can demonstrate to the international community our effectiveness in combating financial crime. And just to give an example, probably the most important FATF recommendation for industry, although everyone has their favourites, Customer Due Diligence Recommendation 10. Now, this is all about financial institutions being prohibited from keeping anonymous accounts or accounts in obviously fictitious names. And in Jersey, this is applied by making sure that any business that is subject to the FATF standards has to register with the JFSC under the Proceeds of Crime Supervisory Bodies Law, and then they become subject to Jersey's Handbook for the Prevention and Detection of Money Laundering, the Countering of Terrorist Financing, and the Countering of Proliferation Financing, which we will from now on refer to as the Handbook, and obviously the Money Laundering Jersey Order 2008, the law that sets what you need to do. The whole point of Recommendation 10 fundamentally boils down to making sure that you know who you are doing business with. Just to continue with Recommendation 10, the CDD measures, the customer due diligence measures that must be taken by businesses, are identifying their customer and verifying their identity. And then if there is a corporate structure or some form of legal person or legal arrangement, you need to look through that structure to identify the beneficial owner, and working up through a structure that is complicated or difficult to find ultimately who it is who, as an individual, a natural person, actually owns the business that is your customer that you're doing business with directly. You need to understand and, as appropriate, obtain information on the purpose and intended nature. So why are these people doing business with you? Why are they your customers? And then throughout a relationship, you need to conduct ongoing due diligence. And that maps into Jersey law and the handbook as illustrated on the right-hand side of the screen. Key recommendations for industry. Recommendation 3, there must be a money laundering offence. Recommendation 5, there must be a terrorist financing offence. I won't read this entire list, but what this highlights is that Jersey, in implementing the FATF standards, is quite simply following rules that are set internationally and abided by every country in the world. Now, there are obviously subtle differences, but everything that this session is about and everything that you will have to do as a regulated business is derived from international standards. Which brings us neatly into the local context. How does this fit into Jersey, and what do you actually need to do on a practical rather than conceptual basis? Jersey's framework for anti-money laundering is driven by primary legislation and secondary legislation. If you're not familiar with Jersey laws, we have primary legislation, which is anything that has law at the end of it, and secondary legislation, which has any order, regulation, or sometimes you might describe a triennial regulation as somewhere between primary and secondary legislation, but that's for another time. Within the Proceeds of Jersey Law 1999, you find the money laundering offences, and we'll cover these in quite a bit of detail later. And you also have the Process of Crime Supervisory Bodies Law, which, as mentioned previously, is what you must register under with the JFSC to become subject to this regime, but also fully compliant with it. The Money Laundering Jersey Order 2008 is the most important piece of legislation in respect of AML, but also probably TF and PF, because it's where you find the statutory basis on which you must apply controls in respect of customer due diligence, reporting, record keeping, employee screening, internal control, risk assessment and management, monitoring and management of compliance with all of the above, and communicating it to yourselves and your employees. Then the handbook. And the handbook is a very long document. It's not far off 400 pages. You don't need to read it all, but within sections it covers off the most important things that you as a business need to be doing. So what happens when you decide that you want to register with the JFSC, or when you realise that you have to register with the JFSC, which is sometimes the case? You submit an application. The JFSC considers that. They do all sorts of checks to make sure that you're not yourself a criminal, or that you're not in some way associated with criminals, and that the business that you are proposing to register is legitimate. And then they will provide you with a no objection in due course. Once you have that no objection, you become responsible for full compliance. And it's very important to note that when first registered, AML's SPs might have provided Schedule 2 businesses with their own policies and procedures, including systems and controls, which is a perfectly legitimate way of complying with the new regime. It might be that over the course of time, customers of AML SPs wish to develop their own policies and procedures, which is acceptable and is the case with some of the people who will be watching this training. Suffice to say, though, that however you achieve compliance with the framework, provided it meets the standards set out in the money laundering order, the primary legislation as well, and the handbook, then you will have everything in place to achieve compliance. It just becomes about the doing. So we've mentioned money laundering, terrorist financing and proliferation financing in various ways, but it's probably worth a pause now to actually look at what we mean by money laundering, terrorist financing and proliferation financing. It's important to bear in mind that money laundering involves criminal property. The reason that we want to stress this is because terrorist financing and proliferation financing often cause some degree of confusion when people are first learning about the topics. Money laundering relies on there having been an offence, a predicate offence, and you can see in the sort of circle on the top right of the screen that from that predicate offence you will develop the proceeds of crime, criminal property. The aim of a money launderer is to get that money into the financial system, and then the aim of the money launderer is to layer it within the financial system by having lots of transactions take place that obscure the source of the funds. And then they want to integrate it back into the financial system in order to fund their lifestyle, in order to commit further predicate offences, perhaps. That cycle is well known, that placement, layering and integration process. And it ties into a PF and TF, and we'll highlight some of the differences on the next slide. But TF and PF are newer in concept to many people, and it's worth just bearing in mind that in Jersey law there is not a strict definition of any of these terms. The handbook attempts to define them, and it does so by rather convoluted cross-referencing to all of the laws, as you can see in the table at the bottom of the slide. We won't dwell on it because what's more interesting and relevant is what's the difference between the three. So as mentioned, we've got the money laundering cycle with the predicate offence, placement, layering and integration. With proliferation financing, which is all about trying to raise funds that will eventually enable a state actor, as in Iran, Myanmar, North Korea, perhaps as the blacklisted states, to obscure the funds that may be from their own jurisdiction, it could be raised by taxes, through the financial system in order to procure materials that will enable them to make chemical, biological or nuclear weapons, and then to move those materials back to their home jurisdiction or to another place in the world for use. So proliferation financing has a similarity in the obscuring phase with the placement and layering of money laundered or laundered money from the predicate offence, but then rather than integrating it back into the financial system or back to the individual criminal, Proliferation financing then has this stage of procuring materials with those obscured funds and then moving the materials in order to make the weapons. Terrorist financing, similarly to proliferation financing, there is a raising of funds stage, and it may be that there is a predicate offence in both PF and TF, but it is not critical. Proliferation financing and terrorist financing can all start with legitimate money, not criminal proceeds. Within terrorist financing, we're often dealing with smaller amounts, and the next stage of the process is to transfer funds between individuals and in their terrorist network in order to use the funds. And the use of funds might be purchasing materials, so there could be a similarity with the proliferation financing stages. But then, unlike proliferation financing, where you move the material somewhere and we hope that there are kind of no uses of chemical, biological, or nuclear weapons out of proliferation financing. But we live in a world where we have to be aware that there are more frequently terrorist acts on a regular basis than those that are the result of proliferation financing. And those fairly small amounts, once they've been raised, transferred, perhaps through non-conventional methods, not necessarily using the financial system, are used to purchase materials to fund a terrorist act. This slide is intended to highlight some similarities and differences as we look at AML, CFT and CPF. The similarities, movements of funds through financial systems, complex structures, desiring to conceal the source of the funds, apply across all the topics that we're talking about. Now, the mitigation strategies are that there are legal and regulatory rules in place, and businesses that perform customer due diligence measures should play their part in trying to detect and prevent all of these crimes. However, there are differences. The objectives are clearly different between a money launderer simply perhaps trying to make their tax evasion seem legitimate versus someone who is trying to achieve a terrorist act, or a proliferation financier who is trying to enable a rogue state to possess weapons of mass destruction. And therefore, there are differences in the way that the offences are prevented and detected. The similarities outweigh the differences, but it's worth bearing in mind, particularly with terrorism financing and proliferation financing, that additional international controls apply, and we will cover sanctions later on. And this final slide sums up the proliferation financing, terrorist financing, and money laundering similarities and differences. I won't spend time reading this slide out, but I will pause for a moment so that people can review it. And if there is further information that would be helpful, this slide deck will obviously be provided as a PDF at the end so that people can review at their leisure. I think the one thing I will stress is that for the kinds of businesses that are dealing in private wealth, as I understand much of our audience today will be, money laundering is more than likely going to be the primary threat, with terrorist financing and proliferation financing more than likely being lesser threats in their overall assessment of risk. And indeed, that is actually the case in Jersey's national risk assessment process. And here we move on to the national risk assessments and Jersey's strategy to prevent and detect financial crime. So the framework in Jersey, and this is very important because you have to know about this, then apply it into your business, puts into place money laundering and terrorist financing risk assessments. We don't presently have a proliferation financing risk assessment document, but I'm certain that will come in due course. In 2020, Jersey's first money laundering national risk assessment was introduced, and it was updated in 2023, September, just before the money val assessors arrived. Similarly, a terrorist financing risk assessment in 2021, updated in 2023, and we've also looked at virtual asset service providers and legal persons and legal arrangements fairly recently. These national risk assessment documents feed into Jersey's 2022 national strategy, its appetite statement, and a progress update on those documents that was released in 2023. Our national strategy for combating money laundering, the financing of terrorism, and the proliferation of financing weapons of mass destruction has 7 strategic priorities. And I'm going to pick a few of those which are most important to you. Chicken and egg at the top right, in case you are wondering, is does the strategy come before the risk assessment, or does the risk assessment come before the strategy? Well, we went risk assessment and then strategy. It becomes cyclical. Understanding threat and performance. What this means is that the authorities in Jersey want more data, and that will impact you, it will impact AMLSPs who service you, because they have to make sure that if the JFSC or other authorities in Jersey ask for data and information about you, you can provide it. Powers, procedures and preventative measures. This means that there will be enhanced powers for the Law Officers Department, there will be tightening enforcement activity. Our strategy as an island is to really crack down where there is suspicion of money laundering, terrorist financing or proliferation financing. Risk-based supervision and risk management. This presents threats and opportunities. Threats in the sense that we might have to pay more regulatory fees. We might have to, as with the first strategic priority, provide more data, but it provides opportunities for strong compliance in a way that will demonstrate to the wider world that Jersey is a strong jurisdiction for AML, and it might also open up the doors for opportunities to innovate in respect of regulatory technology and Comtech compliance technology. Now, Jersey's National Risk Appetite Statement is not a surprising document. It's very logical and ties to the expectations that you might think a FATF or money malassessor might have. We're hostile to criminals and dissuasive towards non-compliance. That means we don't want tainted funds here, and any business that doesn't want to comply with the rules is not welcome here either. Care around high-risk activities and accumulation of risk factors. This is all about activities that if you as a business are doing things that fall within this care around list as we've articulated it here, you need to be very, very sure that you can manage and mitigate the risks. Things that are outside of our national risk appetite should really be adopted by businesses as being outside their appetite as well. And that's unsurprisingly dealing with sanctioned entities, FATF blacklisted jurisdictions, citizenship by investment, and aggressive or abusive tax avoidance. That's interesting because it's slightly stronger than tax evasion. This is aggressive and abusive tax avoidance, which in some jurisdictions is accepted. This is a familiar document, I'm sure, to some people who are listening into the training, and it's a heat map of the sectors in Jersey from their threat and vulnerability perspective. And we can see that trust and company service providers, or TCSPs, are in the uppermost quadrant of the grid, if it was a 4x4, representing greater vulnerability and greater threat. It's important to bear in mind that this was made in 2021, and the rationale for complex structures and the failure to monitor activities gave rise to a suspicion of criminal activity as a common theme. Obscure ownership, reserved powers and third-party involvement also pushed the overall trust and company service provider sector, which also is the largest sector, as you can see it's got the largest circle, into a high space. Now, the reason it's important to bear in mind that in 2021 this was the case is because when Jersey next produces a heat map, it could be the case that the TCSP sector, through the registration of several Schedule 2 businesses that were previously not caught, might actually present a lower threat and lower vulnerability. We won't know until that work's done, so it's worth bearing in mind that for TCSPs in particular, they are the biggest overall sector, the biggest vulnerability and the biggest threat from a money laundering perspective. This is based on national risk, so of course individual businesses may feel that they are not within that section and quadrant. It's a lot of work to try and demonstrate that, though. This is the national view, and certainly what the JFSC as our regulator will see TCSPs as. This slide highlights that from 2020 to 2023, the overall assessment of risk in the TCSP sector, which includes trust company businesses and private trust companies, remains medium high. So as a baseline level, Jersey considers that there is a medium high level of risk in the TCSP sector. That applies to all businesses within it. Vulnerabilities, ownership, customer base profile, complex structures, aggressive tax, use of trust company structures to avoid tax, understanding the rationale for structures. All of these are vulnerabilities, and it's a long list, that mean that that medium-high assessment, that national view, must be taken into account when considering a business's own risk. And sometimes this is not palatable because businesses consider themselves to be not high risk. How can someone who's a bureaucrat in a government agency determine that my business is high risk when they don't even know me? That railing against the system is unfortunately counterproductive, because the regulator, the government, will say, we used a methodology, and they used the World Bank methodology. It is what it is. Respond to our assessment of medium high risk as a baseline. And that is what we must do. And in actual fact, that brings benefits, because it means that there is a level of consistency across industry, across the trust company businesses that might provide AML/SP services, but also within all of the structures on the island working to address money laundering, terrorist financing, proliferation financing. And referring back to the heat map on the earlier slide, consistency in approach, embracing the national assessment of risk, can actually mean that over the course of time, we can influence the movement of what was once high risk into a lower risk category. But it really does rely on that consistency and the adoption of the standards and controls that are in place. I won't dwell on this slide, but it's worth bearing in mind, as previously mentioned, that terrorist financing risk in Jersey is less than money laundering risk. In fact, it's assessed as medium low rather than medium high. Now, we send and receive money into 15 target jurisdictions, and we do have a relationship, particularly in the TCSP sector, with a number of politically exposed persons in those target jurisdictions. However, broadly, most of Jersey's assets move to and from the UK. We are generally a jurisdiction that does have a significantly lower terrorist financing risk, not least because terrorist financing is often micro amounts and not using the formal financial system, which is fundamentally a hallmark of the transactions that take place in Jersey. Now, there will be additional work to put in place a uniform reporting standard, and previous comments about data collection and what you need to do and what your AML/SP will need to do in mind. It's worth just noting that there is more to come in terms of data for terrorist finance. Again, to highlight the Legal Persons and Arrangements, or LPA, National Risk Assessment, or to give it its full title, the National Risk Assessment of Legal Persons and Legal Arrangements, assess all the different kinds of entity and structure that you might find used in Jersey. And perhaps unsurprisingly, trusts, referring back to the use of reserve powers, the use of complicated structures and deeds, came out of that assessment as being the highest overall risk structure that might be used in Jersey. Then non-Jersey companies, Jersey companies, perhaps their sheer scale, limited partnerships and customary law partnerships, moving down towards the lower risk types of entity that are used in Jersey. And again, this is national risk assessment. This is an informed view across the whole of industry. And of course, individual businesses may find that they disagree in their own context, but as a baseline, the kinds of structure that are involved in your business have been assessed at a national level and must be taken account of. And that's where we get to Article 11.2 of the Money Laundering Order, which says, policies and procedures shall have regard to the degree of risk of money laundering, taking account of the level of risk identified in a national or sector-specific risk assessment in relation to money laundering carried out in respect of Jersey. And the handbook stresses that when considering a risk appetite for supervised persons, the board may wish to examine the following factors. What type of customers and activity are considered to be outside of Jersey's national risk appetite? Well, let's say we're not going to be doing business with blacklisted jurisdictions. When conducting a BRA, care should be taken not to focus on any single factor, but all factors, including any identified by a national risk assessment or similar, should be taken into account. And then customer risk assessment. The list below are indicators only and not exhaustive. The results of any national risk assessment or similar must also be considered. So we have in our businesses to take account of these NRA slides and the full documents, in fact. So this is why, while you may find that you are not in full agreement with the assessment of risks and may wish to document your disagreement, they cannot be ignored and their findings cannot be disagreed with by businesses by virtue of the way that the law and the handbook work. So, in practice, what does this actually mean? It means taking account of the NRA in your business risk assessment. It also means making sure that you consider the specific threats and vulnerabilities, and if they're not relevant to your business, document how they're not relevant. If they are, document how you've got controls in place to address them. The JFSC has advised that we use the NRA sector-specific risks as a component of their risk-based supervision. Therefore, even if you don't think that your sector is in the right bucket, the JFSC will be using those buckets to determine how frequently they come and pay you a visit. And how do you demonstrate due regard to the NRA? Put it in your formal strategy, your business plan, your business model, your structure, responsibility statements for the people that you employ and engage with. Employ it within the risk methodology and the risk appetite, and using template documents, which we'll cover off later in the section. This is all sort of pre-populated for due consideration by the governing body. Document discussions in board committees and minutes. Make sure they're reflected in policies and procedures. Fundamentally, make sure that the next section we're going to do a dive into the money laundering, terrorist financing and proliferation financing offences in Jersey. You may wish to pause here for a comfort break. If not, we will get straight into the framework. Somewhat counterintuitive to begin at Article 39A of the Process of Crime Jersey Law 1999, but not so. This is all about offences by bodies corporate and others, and the effect is replicated in Article 10 of the Corruption Law, 63 of the Terrorism Law, 44 of the Sanctions and Asset Freezing Law, and Article 42 of the Supervisory Bodies Law, amongst others. Now, the effect is important because fundamentally what it means is that if the company to whom you are a director, managing limited partner, to which you are charged with governance, has committed an offence with your consent or connivance, you are also guilty of that offence and liable in the same manner as the financial services business. So that basically really underlines the importance of all of the things that we will cover in respect of preventive measures, because if you as an individual consent or connive to enable the business for which you are charged with governance to commit money laundering or worse actions, you may also be found guilty. So, fairly heavy point to make. I won't dwell further. So first, starting with the money laundering offence itself, you can see within the Process of Crime Law that the offence of money laundering carries a 14-year prison sentence and an unlimited fine, and that is acquiring, using, possessing criminal property, entering into or becoming concerned in an arrangement, and knowing or suspecting the arrangement facilitates by any means, as in the financial services industry, facilitating money laundering, concealing criminal property, disguising, converting or removing criminal property from Jersey. All money laundering itself. Most importantly, then we move into the failing to disclose knowledge or suspicion of money laundering. And that may either be for any business or specifically in a financial services business where you have a money laundering reporting officer, failing to disclose knowledge or suspicion of money laundering to the money laundering reporting officer. That's the relevant one for financial service business, but 34A is important to note because any business in Jersey actually has this obligation. It's just that in financial services businesses, they will also have an MLRO who coordinates the reporting process, the assumption being that it will be a more frequent occurrence. Then disclosing information relating to a money laundering investigation or interfering with the material, disclosing that disclosure or knowledge has been made, and otherwise making such disclosure. 5 years and an unlimited fine. This is your obligation to report knowledge or suspicion, but also not to tip off. And the 35.2 and 35.4 offences are what you would call tipping off offences. Mustn't tell people about a suspicion once you have reported that suspicion. And Article 37.4, if you fail to comply with the money laundering order, which we'll cover in more detail than we've actually touched on throughout the presentation already, if you fail to comply with the money laundering order, which sets out all the policies and procedures and systems and controls that you've got to have in place, you may face 2 years in prison and an unlimited fine. Taking a slightly different approach to the list on the other slides in this section for the failure to prevent offence at Article 35A of the Process of Crime, Jersey Law 1999, this is important to illustrate because it really gets to the core of what you need to do as a business. You, person B, are a financial service business, and A is your employee, your agent, your service provider, your customer. You need to maintain and apply prevention procedures to make sure that A does not commit money laundering. And that extends further to where your customer is actually now called C, but A is their agent. So this has gone beyond your employees, your own agents, your service providers, and your customers, now to your customers' agents, twice removed. If that person commits a money laundering offence and you have failed to adequately maintain and apply prevention procedures, you may have failed to prevent money laundering. Now, you may have a defence if you have maintained and applied prevention procedures, if you've complied with the codes of practice or guidance that apply to you and are issued by a supervisory body. And this literally means if you follow the JFSC's handbook, you may have a defence against failure to prevent. Otherwise, there's a very strange and powerful offence, not so much strange now because it's being adopted in many jurisdictions around the world, but as a financial service business, you have a responsibility to try and prevent money laundering in respect of your constellation of customers and their, well, in fact, your constellation of third parties and third parties once removed. Now, you may look at this and think, why have we moved to the sanctions and asset freezing law? Surely that relates to terrorist financing and proliferation financing. But if you recall, money laundering kicks in as soon as a predicate offence has been undertaken or committed, perhaps one should say. And so, in actual fact, these offences are potentially terrorist financing, potentially proliferation financing offences, but are absolutely money laundering offences. Dealing with funds or economic resources owned, held or controlled by a designated person. Now, a designated person is someone whose name appears in a sanctions list relevant to Jersey. Making funds or resources available to that person, making funds or financial services available to any designated person, or having reasonable cause to suspect you are, making economic resources available indirectly or directly to a designated person, if you have reasonable cause to suspect that you are making them available, and making economic resources available to any person for the benefit of a designated person. So basically, don't mess around with designated persons, it's just not worth it. Continuing the sanctions and asset freezing law offences, knowingly or recklessly providing information that is false or material, and this is a common theme in our regulatory laws. If you have to provide information to a regulatory authority, do it properly, do it honestly, openly and transparently. Intentionally participating in activities or knowing that the object or effect of them is to circumvent any of the above articles. So if you are doing something that you think is particularly clever because you're trying to get funds, economic resources or financial services to a designated person, just don't do it. Disclosing information provided to the minister. This is again a tipping off offence in respect of sanctions and asset freezing law reporting. Now, this is worth bearing in mind. Money laundering and terrorist financing, you report to your MLRO. The MLRO is technically not the person to whom you would report in respect of targeted financial sanctions. but in practice it usually is the MLRO. And then failing to inform the minister. Similarly, if you fail to tell the minister, as the MLRO fails to tell the Financial Intelligence Unit about suspicion, then it is an offence. Continuing sanctions asset freezing law. If the minister tells you to do something, do it quickly. If you give false information, again, the recurring theme, if the crime is considered to be a money laundering offence, then similarly extending to partners directors, as in the previous slide, or in the first slide in this section, that all of these offences extend to the partners, directors, members, managers, secretaries, and other similar officers. In respect to the sanctions and asset freezing order, which implements the sanctions in Jersey, where you fail to freeze a designated person's asset and you're told to do so, or you intentionally participate knowing that the object or effect is to circumvent a sanction, then it's a very serious offence, 7 years and an unlimited fine. And then further forward into the money laundering offences here, again, really hammering home that knowingly or recklessly providing information that is false or misleading in a material respect, or pretending that you've got the authority to deal with a sanctioned person, a designated person, when in fact you don't. Tipping off at 6.2 there in the order, and then the prohibition in Article 2.1 of an EU claims regulation, and this fundamentally means that if you try to settle a claim in respect of a contract of insurance that is specifically subject of a UN Security Council resolution, you are breaching the sanctions and asset freezing implementation order. This is a very rare circumstance which is highly unlikely to affect anyone outside of the insurance industry, but it is a money laundering offence. Terrorist financing offences, the similar pattern to the process of crime law, where using property for the purpose of terrorism, possessing property, providing, collecting, receiving that is intended or to be known or suspected to be used for a terrorist activity by a terrorist entity, providing or inviting another to provide property or financial services, intending that it be used to support a terrorist act, and any act, including but not limited below, which facilitates the retention or control of terrorist property, concealing or disguising, removing property from Jersey, or transferring the property to nominees. All of these matters are in that world of terrorist financing. And then an insurer making a payment under an insurance contract. Unlikely relevant to the audience today, but very important to bear in mind that these offences, very similar in respect of money laundering, apply in respect of terrorist financing. The tariff somewhat higher in certain circumstances when we move into terrorist financing, certainly higher in respect of proliferation financing, which comes up next. Failure to disclose knowledge or suspicion, again, this is all about sort of, you must tell the Financial Intelligence Unit when you know or suspect TF or ML. And then tipping off 23.2 and 34.2, very similar provisions mirrored in both laws. Basically, if you do know about suspicion, don't discuss it with anyone except your MLRO. Continuing the theme of tipping off with 35.2 and 35.4, if you become aware of suspicion, do not disclose that to anyone outside of the FIU or your MLRO. And then, importantly to note, at 51.2, directing at any level the activities of an organisation which are concerned in the commission of acts of terrorism. Unlikely to directly apply to a Jersey financial institution or DNFBP, but worth noting that this is very, very serious stuff, and this is why we need to have controls in place at all levels of our organisation, and particularly of our subsidiary structures, if we do have any. Now, a person commits an offence if he or she possesses an article in circumstances which give rise to a reasonable suspicion that his or her possession is for a purpose connected with the commission, preparation, or instigation of an act of terrorism. Unlikely to apply to financial services businesses directly, Nevertheless, worth noting, and 53.1, collecting or making a record of information of any kind likely to be useful to a person committing or preparing an act of terrorism, stretching perhaps the envelope of what financial services businesses might become involved in, but it is an offence in Jersey, and you might, for example, find that if your business doesn't have adequate controls in place and it did possess a document or record containing an information of the kind likely to be useful to a person committing or preparing an act of terrorism, that you are not just in line for prosecution under some of the above articles, but also this one too, which is not a situation you want to find yourself in. So proliferation financing offences, we begin with crime and security law, and fundamentally we are looking at life imprisonment for being involved in nuclear weapons, but also aiding, abetting, counselling or procuring or inciting another person who is not an island person to do a relevant act outside of Jersey with a weapon of chemical, biological or nuclear nature. Taking any action which involves the use of any noxious thing, normally in a room full of people get a sort of laugh at that point, but a serious point to be made. Making a threat that you or another person will take action which constitutes an offence. Willfully obstructing a police officer. All of these are unlikely to directly apply to financial service businesses, but developing, producing or participating in the development or production of a nuclear weapon, proliferation financing, absolutely under Article 2.1b, is directed towards the participation in development or production of a nuclear weapon in certain circumstances, or weapons of other kinds. Biological Weapons Act, very similar matters relating to biological agents as in the Chemical Weapons Act, the chemical agents. Fundamentally, whatever you do, make sure that you don't possess, but also that you don't create an environment through your subsidiary structures, through your engagements with customers, where it might be possible to develop or hold chemical or biological weapons, because this could put you firmly within the territory of proliferation financing. Just to close out the proliferation financing offences in Jersey, we have the Nuclear Materials Offences Act, any act including by omission outside of Jersey that would make you guilty of murder, manslaughter, so significant crimes where it involves nuclear material if you were in Jersey. So an extraterritorial offence where you may do any act including by omission outside of the island, you can be found guilty of the offence as for the offence as if you were in Jersey. Receiving, holding or dealing in nuclear material, 14 years, an unlimited fine, or being reckless as to whether another would do such an act. This could well be relevant in structures, particularly where you've got property holdings in far-flung parts of the world, which are higher risk jurisdictions. And finally, failure to comply with direction given by the minister. If you are told by the relevant minister in Jersey to do something in respect of the development, production or facilitation of any kind of weapon of mass destruction, thou shalt do that, or face 7 years in prison and an unlimited fine. That concludes our rapid tour through money laundering, terrorist financing and proliferation financing offences in Jersey. Up next, we will be looking at your specific responsibilities as a governing body. This overview slide provides detail about all of the aspects within Jersey's law and regulations that governing bodies need to be aware of and indeed have a responsibility to oversee and ensure are implemented on a practical basis. We have the business risk assessment, which we'll deal with in more depth, alongside the risk appetite statement and formal strategy to counter financial crime. Systems and controls, including policies and procedures, are an absolutely integral part of this entire slide, and the governing body retain responsibility for oversight of those systems and controls. Appointments of the key persons, that's the Money Laundering Compliance Officer and the Money Laundering Reporting Officer, are dealt with by the AMLSP where one is appointed. Otherwise, they are the responsibility of the governing body. And with that comes the responsibility, which is a reserved activity, for the appointment of an AMLSP if one is appointed. Customer due diligence, remember back to VATF recommendation 10 and how that's implemented in Jersey, includes identification measures, enhanced identification measures, the application of exemptions, and the use of reliance in appropriate circumstances. And the termination of business relationships falls broadly within the customer due diligence category as an activity that needs to be overseen and responsibility taken for. The assessment of indirect customers through the indirect customer risk assessment is also part of that CDD obligation in the centre. The Money Laundering Compliance Officer, appointed either through the appointment of an AMLSP or directly, takes responsibility for monitoring compliance with all of the laws and regulations relevant in Jersey, and they must regularly report to the governing body. Then we have the Money Laundering Reporting Officer, whose job it is to receive and consider reports of suspicion from everyone within the business, which is why underneath the slide you have reporting suspicion as an underlying theme. Then the MLRO may report suspicion externally where they consider that the relevant threshold has been met. On the top right, sanctions monitoring, which is closely related to the activities of considering suspicion and reporting suspicion and sanctions reporting beneath it, are in their own separate boxes for the reason mentioned previously that while the MLRO under the terrorism law and the process of crime law are responsible for reporting suspicion of terrorist financing and money laundering respectively, sanctions monitoring and reporting are strictly separate obligations to the Minister for External Relations. Finally, moving down the right hand side of the screen, we have employee screening, employee training. And these activities are things that must be done and must be maintained with the oversight of the governing body. And finally, reserved activities are those things that the governing body can in no way pass on responsibility for either doing or deciding to an AMLSP. The next slide is a reference slide and provides links to the specific parts of the regulations where these facets of the governing body's obligations are found. That is a reference slide which is available in the PDF to accompany this session, but is for information. So, for example, if you look at identification measures, that would be found in the Money Laundering Order at Article 13(1)(a). This slide takes the previous slide and illustrates where the governing body, where it has appointed an AMLSP, has absolute responsibilities in respect of the business risk assessment, the risk appetite statement, and the formal strategy. The governing body cannot delegate the responsibility for consideration of risk or its own risk appetite or its own formal strategy to counter financial crime in its business, but can rely on the support of the AMLSP to develop these matters. Systems and controls, including policies and procedures and appointments, are done very collaboratively with the AMLSP, and they have a dotted line around them because it is critically important that these are maintained, but on a day-to-day basis where you've appointed an AMLSP, these are going to be sort of dealt with primarily by the AMLSP itself, and then on a regular basis the board will receive reporting that makes it comfortable. Similarly, CDD has a thick green line around all of those activities because by appointing the AMLSP, you are appointing someone to take care of the day-to-day running of these activities. Termination of business relationships sits within this CDD section and is also highlighted in a yellow colour simply because while the AMLSP will on occasion find that there are matters that indicate that business relationships needs to be terminated, as in you can't collect relevant due diligence or there is suspicion of money laundering which results in the need for a business to cease activities with a certain customer. This cannot simply be passed to the AMLSP to do and document. It needs to be referred to the board, and so there's a collaboration there on a practical basis should this fairly rare, in fairness, situation arise. The Money Laundering Compliance Officer operating with regular reporting to the board is running in the AMLSP at all times. And the MLRO, the Money Laundering Reporting Officer, they will do their job of considering and receiving reports of suspicion and externalizing suspicions to the Financial Intelligence Unit. But it must be remembered that everybody who is involved in a business has that responsibility to report suspicion into the Money Laundering Reporting Officer to make sure that the process works. Sanctions monitoring. AMLSPs have well-developed systems to perform the task of monitoring sanctions lists against customer names and customer details in order to identify where sanctions may arise. But similarly to terrorist financing and money laundering reporting, sanctions reporting is an absolutely shared responsibility by everybody in a business. Employee screening will generally be dealt with by the AMLSP, and so has a thick line around it. Should be borne in mind that with employee screening, we're including not just employees in a conventional sense, but also directors and those charged with governance of the AMLSP's direct customer. Finally, employee training, a dotted line around that one, because it's very important to bear in mind that everybody in a business has a responsibility for maintaining their own continuing professional development or CPD records, and completing all mandatory training. So while the AMLSP will coordinate it, it is very much a shared responsibility. And I didn't mention on the previous slide, and for the eagle-eyed who may be watching, record keeping, the AMLSP will maintain records to support all of these activities. It is a shared responsibility, though, to make sure that if you hold records that are relevant to your business, that they're made available to the AML-SP. Quick question. Who is your money laundering compliance officer? And very importantly, who is your money laundering reporting officer? If you are not aware of who holds these roles, you should get in touch with your AMLSP to find out. It's very important that you know who your money laundering reporting officer is, and with an AMLSP this might be a telephone number and a resource box with several people from the AMLSP who are supporting this function, but there will be a named person who is your money laundering reporting officer, and you need to be able to get in contact with them in the event that you do form a suspicion. And this is all about reporting. I've mentioned that reporting of suspicion is a shared responsibility, and it's worth now just kind of stressing within the terrorism law and the proceeds of crime law for money laundering and terrorist financing irrespectively. In the course of carrying on your business, everybody within a supervised person is required to raise an internal suspicious activity report as soon as practicable, and really that means immediately in most circumstances where they have knowledge or suspicion, or where there are reasonable grounds for having knowledge or suspicion that another person is engaged in money laundering or terrorist financing, property constitutes the proceeds of criminal conduct, any property has been or is being intended to be used in criminal conduct, or any property is or may be terrorist property. Form suspicion, report to the MLRO, who will in turn externalize reports to the FIU if the threshold conditions are met. For targeted financial sanctions, it's a different process, but it's very, very similar. And if you recall from the detailed list of ML and TF offences under the sanctions and asset freezing law, if you know or have reasonable cause to suspect, and this is an objective test, but just knowing or having cause to suspect that you're in possession or in control of, or otherwise dealing with fundamentally anybody who is on a sanctions list as a designated person, steps must be taken to freeze the accounts and economic resources, to refrain from dealing with them, and to report any findings to the Minister for External Relations together with additional information. That reporting is going to be to the MLRO, who will make sure that it is routed to the right person within your AMLSP who deals directly with the Minister for External Relations. Usually it's the MLRO. It will definitely be a member of the team that works closely with the MLRO. And this is just a fairly new development in Jersey, sanctions and asset freezing law coming in 2019, and it gives a little bit of flexibility to AMLSPs not to have their MLRO overloaded with all of the responsibilities of sanctions reporting. But again, that anti-financial crime team will work very closely together. Remember the tipping off provisions both for SARs and for sanctions reports. Once a SAR or a report to the minister has been made, it must not be discussed with any other person. This is critically important as it bears not only a 5-year prison sentence and an unlimited fine as an offence, but it could actually result in money laundering, terrorist financing or proliferation financing taking place. It's critical to remember not to dip off. But of course, on a practical basis, the MLRO and those charged with governance, for example, the Board of Directors, will discuss matters relating to SARs and reports to the Minister. Extreme care must be taken at all times not to disclose information more widely. So this is not to say that directors of a business are not allowed to know about suspicion within their business, but it is about making sure that only those who are allowed to know and who need to know are aware of suspicion being raised and suspicion being reported. The AMLSP. This section is going to tell us a bit more about that anti-money laundering service provider role. Who are the parties? So I've mentioned AMLSP several times, and if you have had any doubt, they are a person, a business, that must be registered by the Jersey Financial Services Commission to carry on classes of trust company business or fund service business. And rest assured, your AMLSP will be certain that they hold these classes of business and also that they are not a managed entity, a managed trust company, or a natural person. The direct customer, and that's you, the direct customer, or the AMLSP direct customer to give it its full title, is not a regulated person carrying on regulated business. So it's not a full presence fund business, bank, trust business, investment business in Jersey. But it is required to register under the supervisory bodies law. So it is a Schedule 2 business, for example, a private trust company. The indirect customer, which is the customer of the direct customer, are treated by the AMLSP as its own customers when the AMLSP performs those CDD activities and various other activities. And this enables the DC, the direct customer, to step aside from the equation in certain circumstances so that the AMLSP is applying all those policies and procedures for customer due diligence and everything else directly to the indirect customers of its direct customer as if they were its own. We've got distinct roles, but there are clearly overlapping activities. Very important to bear in mind that this is not overlapping responsibilities. The direct customer is responsible for everything that appertains to its business, but it can delegate some of the performance of those activities to its AMLSP. And on the previous slide, we talked in depth about it. So this slide is more of a reference and also to draw particular attention to the fact that the board or those charged with governance of the direct customer are responsible for the business risk assessment, the risk appetite statement, the formal strategy, oversight of systems and controls, oversight of the AMLSP, and of course, reserved activities must be performed by the direct customer, with the AMLSP picking up on virtually everything else on a day-to-day basis. Business risk assessments are critically important to every business, and they don't have to be huge documents covering the same risks for every business, because if you can imagine, a global bank based in Jersey is going to have a very, very highly developed and sophisticated business risk assessment covering a multitude of activities. Whereas a small Schedule 2 business is likely to have somewhere between 25 and 35 lines in their business risk assessment, which draw out specific risks in the regulatory framework and those that are particularly relevant to its activities, rather than hundreds of lines in a much more significant business. There are ways to do this. And the first one is for the direct customer to have its own business risk assessment. It will be aligned to the handbook and it will be maintained by the direct customer with support from its AMLSP. And that document stands alone. But the handbook also provides other routes. And these routes were taken when this regime first came into play in June 2023 through to September 2023 for other entities that had a bit more time to register. And the handbook provides two methods for achieving this business risk assessment. The AMLSP takes its own business risk assessment, creates a form of its own business risk assessment. So as we said before, hundreds of lines for a significant business, maybe fewer lines for a direct customer. And then the direct customer is able to adopt that form of the AMLSP's BRA. Alternatively, the second method is that the AMLSP can take the CDD that it collects in respect of its direct customer and use that to produce a customer risk assessment of the direct customer. In fact, it must do this for every single customer that it has, as must all supervised businesses for all of their customers. But then the AMLSP might use that customer risk assessment as its own BRA. In those circumstances, you've achieved the requirement to have a business risk assessment through different routes. Viewers, listeners, are likely to be adopting the first method where they have their own business risk assessment. But it is important to bear in mind that your AMLSP has you as a customer and must therefore assess you according to the strictures of the Jersey legal and regulatory regime. And that has resulted in a CRA of you that might be adopted as your BRA. The customer risk assessment is, as I said, absolutely critical. It's required in respect of each and every customer by every single supervised person in Jersey. That's any business registered under Schedule 2, from banks to very small TCSPs operating in the Schedule 2 regime. CRAs, unlike BRAs, take generic factors into account, and these are dictated explicitly by the money laundering order and expanded on in the handbook. Customer risk assessments, unlike business risk assessments, do not feature an assessment of inherent risk and an assessment of risk after controls, which results in a residual risk. That means that a customer risk assessment is impossible to downgrade because it is based on those generic statutory factors. Irrespective of the BRA's conclusion, you may still have higher risk customers dictated by the CRAs. You are mandatorily obliged to have a CRA with these generic factors. And therefore, it is likely that the AMLSP and the direct customer's CRA conclusions will be identical. In fact, it's hard to see how they will not be identical. Where geographic factors or other high-risk factors such as pets put a CRA into a high-risk category, you cannot downgrade it, and that's a very important note. So back to the earlier slides where we know that Iran, Myanmar and the Democratic People's Republic of Korea, DPRK, or North Korea, any dealing with those countries immediately means that the customer is high risk. That's an extreme example, but in the last few years we've seen countries such as South Africa being grey listed by the FATF. Any customer in South Africa or with a specific nexus to South Africa is likely to have to be rated as high risk because of that FATF grey listing process. It is highly likely that the direct customers BRA are likely to be very similar because of the small concentration of customers in the direct customer. And it's very important to bear in mind that it's perfectly acceptable to determine that through the CRA process, customers present a high risk. Overall, your business risk assessment might determine that customers being high risk, overall business risk is high risk. And you might document that you consider yourself to be high risk. There's no shame and there's no problem in being a high risk business. What the JFSC is interested in when it comes to inspect you is you understand the national risk framework, the money laundering order and the handbook as they appertain to your business, and that you have assessed risks in a reasonable and objective manner and have adopted a risk that is provided for within that wider framework. So just because you're high risk doesn't mean that the JFSC are going to be treating you particularly differently. In actual fact, it can have the converse effect that the JFSC will recognise that you understand your risks in light of that wider framework and have documented them properly. We noted that the AMLSP and its direct customer both have overlapping activities. And one of the things that is very important when you enter into an agreement, either as an AMLSP or as its direct customer, are to bear in mind the concept of reasonableness. This is important because Article 10A of the Process of Crime Jersey Law 1999 states that where an anti-money laundering service provider is appointed, in considering a defence for a contravention of or a failure to comply with the money laundering order, the court must have regard to the reasonableness of the appointment and the oversight of the AMLSP. Therefore, a direct customer needs to make sure that they have documented why they have selected their AMLSP, that they've documented that decision properly, that the terms and conditions of their appointment are appropriate, and that the oversight arrangements of their AMLSP are sufficient. The money laundering order also notes at Article 9A, paragraph 6, where an AMLSP is appointed to fulfil the obligations of a relevant person, both the relevant person and the anti-money laundering service provider are responsible for fulfilling the obligations. So while we know that the direct customer is responsible for their own business, the AMLSP is also taking on a role where they have responsibility in law for the activities that they perform. And I mean, it's quite logical, really. These are activities to prevent financial crime. The AMLSP's considerations would be, are they the right AMLSP? Is it clear how the direct customer has made their decision? And similarly, are the terms and conditions appropriate? And importantly, where the DC is thinking about how they're going to oversee their AMLSP, the AMLSP needs to be thinking about how they're going to support the DC in their oversight of them. The handbook at section 18.3 gives guidance to the direct customer and sets the ground rules for how to make sure the AMLSP is going to be monitored. They need to be sure the AMLSP is up to the task, quite frankly. They need to be satisfied that suspicions can be and will be reported. And it notes that you cannot delegate the appointment of the AMLSP, which is quite logical. It also provides guidance on the own versus the AMLSP's business risk assessment, which we've covered previously. And it states that the dividing up of the performance of activities can be quite flexible. So it really is down to the DC and its AMLSP to decide precisely who does what among all of those activities on the aforementioned slides. Good practice we've seen is that there's a formal agreement and that there's a document that sets out DC's adoptions of the AMLSP or its own formal strategy, business risk assessment, systems and controls, including policies and procedures, similarities and differences between the AMLSP and the direct customer, reporting arrangements, and the form, frequency and content of reporting. Minutes, evidence, consideration of challenge, and where identical arrangements with the same people are made, for example, you have more than one Schedule 2 business and with an AMLSP, that you document that everything is clearly done for each business. And as you can imagine, the converse is true where practice could be improved. Simple, not clear who does what, ambiguity around who's going to perform the activities, or overly complex arrangements. Fundamentally, from a regulator's perspective, if it's not documented, it's not done. And better documentation, which isn't necessarily onerous, it's not war and peace, but it is clear and iterates through each party and what they're going to be doing, it is very clear. Now, as direct customers watching this, you might be thinking, well, why do I care about the AMLSP? But bear in mind that you have responsibility for overseeing the activities that the AMLSP performs in respect of your business. The handbook at section 18.2 works through what the AMLSP needs to do and how it can do it well. And it talks about all of the aforementioned things that we have touched upon: reporting, monitoring, oversight, customer due diligence, business risk assessments, etc. Good practice is that we can see the BRA is considering all of this within its own kind of as it pertains to the AMLSP. That the risk appetite of the AMLSP agrees that it will perform the activities for and on behalf of its direct customers, that policies and procedures are developed that make it clear who does what, where and when, and that it's making the right notifications to the GFSE about the key people who will be appointed, the MLRO and MLCO. That there's support in place for the key persons. So as a direct customer, you will have a MLRO and an MLCO, and you want to know that the MLSP is actually supporting them in doing their jobs. There's a written agreement similarly, and there's strong consideration of adequate capacity and the ability to take action in the event that matters need to be dealt with. And just like before, in respect to the direct customer, where people have already, given that we're only really 10 months into this regime proper, there's been a cursory approach, there's a lack of clarity, delegated to compliance, so activities are not being dealt with by the first line of defence in firms, and the board of the MLSP haven't been briefed in full in respect of what's going on, and therefore oversight is not entirely clear. So throughout this session, we have noted that the business risk assessment is an absolutely critical document. The purpose of the BRA, well, it's a code requirement, it's a handbook requirement within the AML BRA detailed in section 2 of the handbook. It's an ongoing requirement, it's not an annual job, and we know that the JFSC are particularly interested in how businesses develop and apply their BRAs to make sure they stay living and breathing. The board have to own the business risk assessment. They have to review it when major events take place, and there should be a genuine review. Evidence of that review should be minuted and documented properly within the BRA itself, and it should be taken into account in respect of the business risk assessment, business risk appetite statement, and the strategy to counter financial crime. These documents should all work closely together. This slide highlights that the board is primarily responsible, but that it involves all sorts of players, and MLRO and MLCO, all staff, management, compliance, legal and risk. In the context of an AMLSP and a direct customer, the board of the direct customer and the AMLSP are working together to make sure the document is living, breathing and relevant. What goes into a BOA? Well, you start by gathering data, and that's your customer risk assessment data. It's about the customers that you have, where they sit in the world, the NRAs from Jersey, the national risk documents. You then consider risks. So taking all of the legal and regulatory requirements and all of that additional data, you look at where you sit, what risks are relevant to your business and how you will implement controls to address them. Once you've identified risks, you will assign owners, and in the context of a direct customer, this is largely going to be either the board of the direct customer itself or the MLCO appointed by the AMLSP, and in respect of reporting risks, the MLRO. And then you review the BRA and you consider how the risks and the controls are going to operate together in harmony in order to arrive at a conclusion in respect of risk. Now, it's a cyclical process, the BRA, as I said, a living and breathing document. And what I mean by a living and breathing document is not that you update it every single day, but when there are events, for example, suspicion arises, for example, a control is found through ongoing monitoring not to be working effectively, that you go back to the risks in your BRA and you make sure that it maps appropriately to them. If you enter a new geography, you consider whether that geography is on the FATF grey list, on the FATF black list, or indeed on the JFSC's own additional lists, which are found in Appendix D2 of the handbook. Often, the financial crime BRA will have operational and compliance aspects to it. Fundamentally, for Schedule 2 businesses, the BRA only needs to address financial crime risks. However, operational and compliance risks often talk to these. It needs to be mapped to the local regulatory requirement. There are some easy wins in the BRA in the local regulatory environment. You need to work through the BRA, and where you find that the BRA is identifying matters of particular concern that might be notifiable to the JFSC, that they are notified. And as a result of your ongoing monitoring activities, you might find that the BRA needs to be updated. As I said, you can upgrade risks, you can downgrade risks based on the activities of your monitoring activities and your understanding of your business. But once you've done it, it does need to be revisited. This example is a template BRA that many of the people on the call will be familiar with from the template pack that they have been provided. You can see risk types, and these are all financial crime risks, and you see risk categories where there might be a breach of AML, CFT or CPF, the framework in respect. The likelihood of that is possible before the application of controls. The impact of that might well be catastrophic after the application of controls, and therefore the inherent risk sits at high. Now, within this particular BRA, section 3 to 12 of the compliance manual has enabled the board to consider that the likelihood after controls has reduced from possible to rare. But the impact after controls the board still considers to be catastrophic. However, that downgrading of likelihood results in a residual risk of low. Adequate discussion of how the controls are going to reduce that risk and how the board are comfortable with that downgrading to the application after controls, clearly documented in board minutes and in the further columns on the spreadsheet, which we don't have on this slide, will enable the board to sit comfortably that they have considered a risk, determined a risk, and that they and then move on to the next line, but also make sure that they revisit this on a regular basis. And those controls in sections 3 to 12 of the manual being tested on a regular basis will mean that the board might revisit things if one of those controls was proven not to be working as effectively as they first. You'll recall from the slide which had all of the obligations that the DC must oversee, or in fact the board of any regulated business must oversee in a grid, that systems and controls, including policies and procedures, are a very important component of the regulatory framework, and indeed the handbook majors on the systems and controls and their application. Through a straightforward policy statement, the supervised person is able to explain quite clearly how it is going to maintain compliance with its systems and controls. And this example says that it will apply all aspects of the legal and regulatory framework into its business by maintaining a comprehensive suite of policies and procedures. It explains how the MLRO and MLCO will have access to the governing body. It explains how obligations in respect of reporting suspicion will be adhered to by everyone within the business. AML obligations in respect to training and development will be adhered to. And to support compliance with the legal and regulatory framework, the supervised person will at least annually review the manual that forms part of, or the compliance policy forms part of, P&P workbook, its BRA, and the performance of its MLSP. And as a final line, in terms of the policy of the supervised person, it notes that the National Strategy for Combating Money Laundering, Terrorist Financing and Proliferation Financing, the supervised person shares Jersey's national commitment to preventing and eliminating financial crime. Similarly, in order to satisfy the requirement to have a formal strategy to counter money laundering, terrorist financing and proliferation financing, it can be quite daunting to think, what does my formal strategy need to involve? Well, fundamentally, a strategy for a business that isn't operating at scale can be relatively straightforward. And the formal strategy, or the formal approach, it's fairly tactical, this example, is to achieve compliance in line with the output from the policy statement and its BRA by the continual performance of all of the activities that must be performed in line with the money laundering order and the handbook and the wider legal and regulatory framework which we've covered. And finally, after due consideration through the systems and controls, including policies and procedures detailed within the manual, if a customer or prospective customer falls outside of the supervised person's risk appetite, the supervised person will decline to accept that customer. So the strategy is effectively to do all the things that you've got to do, and if those things indicate that someone is wrong to do business with, you won't. That's quite a strong control, and while tactical, hopefully an effective strategy for a business of the relevant scale. And you may recall that the risk appetite, the business risk assessment at the national level was a bit chicken and egg. The risk appetite statement proposed is fairly straightforward, and having considered national risk, having considered its formal strategy, having considered its desire to comply through the compliance policy statement, the supervised person draws a conclusion that it has no appetite to contravene Jersey's national risk appetite, which is one very strongly implied by law and also a sound starter for 10. The supervised person then says it has medium appetite for customers who are subject to due assessment within its CRA process are identified as high-risk customers. In reality, many PTC type structures and Schedule 2 businesses who appoint AMLSPs are likely to have higher risk customers. That's because of geography, that's because that PEPs may be involved, and it's unavoidable, bearing in mind that we're talking about generic factors that determine that higher risk rating. Not to say that you can't have appetite for higher risk customers, and indeed you could decide to have a high appetite for high risk customers. You simply need to acknowledge what your appetite is in respect of those customers and make sure that you do all the things that you have to do. The supervised person does not consider customers who perform sensitive activities in Table 1 of the Sound Business Practice Policy, and the Sound Business Practice Policy document iterates through activities that might cause Jersey reputational or financial crime risk. And all of the activities within Table 1 are regulated activities, and therefore most supervised persons would actually not consider those activities to present higher risk as it's sort of the things that they do day to day. However, the supervised person only has moderate appetite for those activities within Table 2. And Table 2 is the more conventional sound business practice policies. And you will find within that table several activities that might present fundamentally reputational risk. Then low appetite for non-Jersey regulated activities, pharmaceuticals and scientific research. These are activities that are more difficult to have oversight of, and pharmaceuticals and scientific research, you can remember our session on proliferation financing earlier, presents quite extreme risks, and so you do need to exercise extreme caution about activities in those spaces. And of course, citizenship via investment, weapons and dual use goods, very significant terrorist financing, proliferation financing and money laundering risks within those schemes. We recommend having no appetite for those activities. Again, repeating, business will be declined if business is outside of risk appetite. We mentioned previously that certain activities are reserved, can only be performed by the direct customer, and this is just a quick recap that you can only appoint the AMLSP yourself. You cannot deal with blacklisted jurisdictions, and if for some reason a direct customer decides to deal with blacklisted jurisdictions, it must make that decision itself. The AMLSP cannot make that decision. The scenario that we might consider there is where a country or territory that is not on the blacklist now joins the blacklist, and how would the supervised person deal with that change? It might well be to exit the business, but for a period of time you would still have a customer while you exit the business. And then if you merge, continue, wind up or are taken over, the activities in respect of record keeping and notifying the JFSA need to be undertaken by the supervised person and cannot be undertaken by its AMLSP.
It's entirely possible that you, as the governing body of a direct customer, won't find yourselves engaging directly with the regulator. However, it is entirely possible that at some point you may. And this slide is intended to highlight the fact that actually regulators are just people, and one of the things that they want to see is that you understand what it is you have to do in respect of the anti-financial crime framework, that you're doing it, and also that you are fully prepared for the questions that they might ask you. So before you engage with the regulator, if the event does arise, be sure to understand the regulatory requirements and be able to explain how you bring them into your business. When you do engage with regulators, be concise in response to the questions that they might ask, but also be open and transparent. And if you don't have an answer to hand, it's perfectly fine to say, I'm not sure. Where possible, highlight best practice and really bring to life how you are actually fully engaged with the regulatory framework, including all of the national risk considerations. Afterwards, document your interaction, and if, for example, you did say, I'm not entirely sure, let me check, make sure that you follow up on any commitments. And then use whatever you learn as you move forward to continuously improve your AML framework. This slide brings together much of what we've covered in this session. As a senior leader, you don't need to be involved in the minute detail of every single monitoring event and activity that is undertaken. You don't need to personally check every single passport and utility bill that's gathered as part of CDD, for example. But you do need to understand the requirements. And while you are not the AMLSP itself, you can still, within your business, establish a culture of compliance and lead amongst your fellow board members or governing body members, as they might be. Lead by example. Set clear expectations of your AMLSP and of anyone who works within your business.
Make sure that you provide the resources and training and encourage collaboration both between yourself as the governing body, staff that you may have, and also the AMLSP. Make sure that where there are mechanisms for monitoring ongoing compliance and oversight, they are regularly reviewed as part of that continual refresh of the BRA, and stay informed. Make sure that you subscribe to alerts from the JFSE, for example. Check in with the AMLSP, and when you have time with the MLRO and MLCO, ask them what's going on. What has changed since we last met? If possible, encourage innovation and invest in technological solutions. Now, this is unlikely to be something that you will directly invest in as a direct customer, but if your AMLSP is, for example, using EID solutions, is, for example, using technology that might improve the customer onboarding experience and your monitoring of compliance, for example, sanction screening, lean into that. Really take advantage where technology can improve things. Regulators particularly like to see that people are taking advantage of technologies that make compliance more straightforward and more robust. You hopefully remember, towards the beginning of the presentation, we talked about the failure to prevent offence, FTP. Considerations in respect to failure to prevent really do cut across everything that you need to be doing. So in closing, we're going to consider what you might do. Defences in respect to failure to prevent, and you may recall that if you can prove that you have adequately maintained policies and procedures, that you are able to provide a defence in respect of failing to prevent. And that's that constellation, not just of your customers, but also your employees and the agents of your customers at an extreme. The burden of proof in respect to the failure to prevent offence is unusual in that rather than having to prove beyond reasonable doubt that you did something, rather they simply have to prove that you did not adequately maintain and apply procedures. And you have to prove that you did. So given the assumption is that you did not maintain and apply the relevant procedures, it's critical that you ensure that your record keeping in respect of the relevant procedures is complete, accurate, and cuts across your entire customer base. All of the documents that we've covered in this session are critical documents, and the record keeping in respect of those, while maintained by the AMLSP, should be something that you make sure is in place. And it covers things like HR records, obviously suspicious activity reports, board and committee meetings, and the minutes of those meetings are absolutely critical in documenting not just that you had policies and procedures, but that you were living and breathing them in practice. When we say adequately maintained, talking about the FTP offence, it's procedures in relation to A, and that means that you need to be sure that you have documented procedures in respect of agents, customers, customers' agents, employees, and service providers. Now, the procedures are going to need to be demonstrably tailored to each of these groups, and the template procedures that you will adopt and adapt as necessary, probably minor adaptations if any at all, do achieve this. And so back to that, making sure that you consider them and that they're regularly maintained, keeping everything ticking over perhaps is the best way to make sure that you have this defence against failure to prevent. But it's not just about failure to prevent. This is what you need to do in practice. For most direct customers, this will be an annual exercise because the volume of transactions is low, your customer base is very stable. But these are all considerations that are good practice, if not best practice. Adequately applied policies and procedures look like this. The second part of the defence, as we touch upon here, is that at a high level, B needs to be sure that their procedures are being followed. So, keep the business risk assessment and strategy up to date. Follow the customer risk assessment steps that are outlined in your PMPs, but that are also outlined at that statutory level. Make sure that there are no encumbrances to the collation of CDD or enhanced due diligence as might be necessary. And if you do have due diligence in respect of employees, agents or service providers, that's all well maintained. On an ongoing monitoring basis, periodic reviews as some businesses call them, make sure that you check certain transactions and that where there are trigger events, for example, a high-risk country suddenly comes into your customer base through a FATF listing process, or there is an unusual transaction that is outside of what you would have generally expected, make sure that that ongoing monitoring program takes account of all of those things, that you look into anything unusual. If you have outsourcing agreements, make sure that they are applied in line with the JFSE's outsourcing policy. And while you will not use reliance arrangements are more than likely to be part of that defence against failure to prevent, just for completeness. So the final two slides, I will not read out every single one of the key terms on key terms 1 and key terms 2. Suffice to say that in respect of these key terms, they cover off any acronyms that you will have seen in the presentation and are a helpful guide in case you do wonder, what did they mean by POCJUL, the Proceeds of Crime Jersey Law 1999, or what was SDD, Simplified Due Diligence, which is unlikely to apply in your circumstances, but is something that is an acronym that is commonly used in the regulatory world. Thank you for listening to this session, or watching this session as it may have been. Please think before you print, and good luck in your role as a director.